So one of the important things to know about the profit and loss, there's just some basic accounting terms which are important to know. And people sometimes get these confused, so I thought I'd just go through them. So first of all, gross revenue is the same thing as sales. So, gross sales, gross revenue, same thing. Net revenue is taking that gross revenue or the total sales number minus contra revenue. So contra revenue is just refunds or money back or whatever, sales give backs and returns, minus also the cost of goods sold. And the cost of goods sold are basically the costs associated directly with delivering the product. Indirect costs or the rest of the expenses for running a business. So not the expenses tied to delivering a specific thing that's been sold, form the rest of the expenses. And these include things like rent, full-time employee salaries, marketing expenses, office supplies, copy, I don't know, copy leases, copier leases. Those used to be huge. Those sorts of things. And then net operating income is basically what you get when you subtract all the different expense types from the revenue type. So you'll get net operating income. The reason that this is net is because you still need to reduce that income by taxes, amortization, and depreciation expenses. So once you reduce it by those things, then you have operating income, and that's what you get to take home. The last thing I want to talk about is line items, and line items are basically like how these reports are organized. Okay, so let me stop there and just see if you have any questions. So this is a visual representation of what I just said. And if you have like QuickBooks or FreshBooks or some accounting program that you run your business with, like you're going to be familiar that this is sort of what that looks like. So here's the line items, these things over here. Like here's the line item codes. Each one of these is a line item, whether it's an expense or a revenue, these are still line items. And the general rule of thumb is you take the revenues minus the expenses to get the income. Okay, that's just at the 30,000 foot level. Revenue we sort of distinguished as, it could have many sort of subcategories here. For example, the P&L that I have on the screen has revenue from sales. It has internet income. It has royalties. It has miscellaneous revenue, special programs, and revenue transfers. Those can all contribute to the overall revenue, okay? And the expenses, as I said, are comprised of direct costs, which are this, the same as cost of goods sold. And those are here. In this case, subcontractors and materials. So books, and in this P&L, the company is paying its tutors as subcontractors. So it's able to recognize those items here as direct costs. Then the indirect costs are here. And we talked about those salaries, employee benefits, taxes and licenses, advertising, credit card service charges, those sorts of things. They all live here. And that gives you your total expenses. And by reducing the revenue number here, the net revenue number, by all these expenses, we get to this net income or EBITDA. So earnings before income tax, depreciation, and amortization. So hopefully that's not too confusing, but I want to stop and see if you have any questions about the terminology. Okay, so we're going to drill down a little bit now. So that first area, revenue and direct costs, this is what that top sort of third of the P&L looks like. So you have your sales, and in this example, there are test prep sales, there's homework help tutoring, there's miscellaneous revenue, which in this case covers classes and online. You have that contra revenue account that I mentioned right here, which is represented as negative revenue. And then you have a couple of other contributing revenue streams, exam scoring, um, admissions, like college admissions. So those things are here. And again, the cost of goods sold are represented here by the contractors, an agency that does the exam scoring for the company, and materials, so books and things like that. And all these together produce your net revenue. Okay, so you're gonna have sales minus returns or money back guarantees minus expenses for delivering those specific products. And that's going to give you your net revenue. So this is not auto calculated. So don't try and do the math and think, what's going on here? Now that middle third, these are the indirect costs. So again, they're expenses that are associated with running the business. They're just the expenses that are required to basically run the office or pay a lease or get a bathroom repaired, like the things that are not directly tied to delivering the product or service that has been sold, right? Sort of a catch-all for all of the other expenses that go into running a business. And so from these two components, you're going to get that net income, also known as, these three things in yellow here are interchangeable: net income, net operating income, or EBITDA, which is earnings before income tax, depreciation, and amortization. And once you do subtract income tax, depreciation, and amortization, you get your operating income. And that's the income, again, that you are able to pocket and take home.
Did you say the net income, the net operating income, and the EBITDA, those are interchangeable terms?
Those are interchangeable terms.
Okay, gotcha.
Any other questions so far? Okay, so ideally, you're looking at a document like this once a month. So this is, I apologize for the size here. I was just taking some old P&Ls that I had worked on and screen shooting them. So the full P&L, you'll recognize the three components that we just went through. They're all here, right? And you'll notice on the right column, sort of the gray column there, it has a prior year number. And most P&Ls, a good P&L gives you your current month performance and also the same month from the prior year. And the idea is that you want to do a couple of things. You want to basically see how you did versus the prior year. I mean, it's accurate it can be accurate, but not precise because, sales cycles change slightly over each year and expenses come due at different times each year and that sort of thing. But it's a good directional indicator of performance. So you want to look through each line item. This is a matter of practice. You want to look through each line item, um, review it for accuracy, and then compare it to the prior year to see how you did. So a column that isn't in existence here would be one more column to the right would be sort of a plus or minus versus prior year. Again, prior year thinking is it's just helpful in a directional way. It's not the be all end all, but it is good to make a habit of comparing performance and spending and everything else you do versus a similar period from the prior year. So other ways to use the P&L strategically. The P&L will allow you to view spending. So sometimes like you can catch if you've paid a bill twice or if you've paid for something that you shouldn't have just by auditing the line items. It will also help you, double check your sales. Like you want to make sure that the revenue that you're recognizing was processed correctly. And we talked about it'll allow you to compare line items from the prior year. And I like to think of it as a monthly report card, so to speak. Um, so whenever I oversaw a P&L of other P&Ls, like a large P&L with multiple locations, part of our process would be, we'd look at sales daily, right? Just number of sales, number of enrollments in tutoring or test prep or whatever. We'd look at that daily and just to get a sense of how we were performing. But the health of the business would come when we looked at the P&L at the end of each month, because we would see the revenue, the expenses, and the income and compare it to the prior year. So it's more of a granular look at the business. And I don't want to get too into the weeds on accounting, but sometimes, basically a sales dollar is not is very rarely recognized all at one time. So if you sell $1,000 tutoring package, it's usually spread over the life of that enrollment. So this is another reason why the P&L is helpful, because it, it's the same sort of accounting process year over year. And so those accruals sort of even out over time, and it makes comparison a little easier. So what do you do if you don't have a prior year P&L? It's fine, like just starting, making a P&L is important, and getting into the habit of actually using it as a comparison tool. That's, more important than coming to the table with everything you need to get going. If you don't have a prior year P&L, you can use your monthly P&L to compare your results versus what you expected. Maybe you built a forecast, or maybe you built a budget when you made a business plan. And even if you didn't, as I said, it's helpful to just double check on expenses and sales, make sure everything was processed properly, or that you didn't pay a double bill, or anything. It's just helpful with accuracy. So using the P&L is helpful to create a foundation for budgeting. So, ideally you want to budget for the coming year before you're done with the current year. So, starting anytime from like June forward, if your fiscal year is, let's say it's a normal calendar year, January through December, anytime from June forward, you want to start budgeting or forecasting for that next year. It's easier to do later in the year because you'll have more data available to you. And most budgets from existing businesses are built on prior year performance. And that's just another way that the P&L can be helpful. So if you look at a full 12 months of P&L results, you can use that to help you create the budgets for your next year. And there are simple ways to do that. And again, like, our businesses aren't so complex where you have to worry about nailing it to the penny. Like, if you did $100,000 of business this year and you want to grow 20%, then you would take that 100,000 times 1.20, you get your $120,000 for revenue, and you could spread that out over 12 months and then figure out the expenses as a percent of that revenue. That's an easy way to do that. It's called top-down budgeting. You can also build your budgets in a different way. You could take the expenses from a 12 months of P&L and just put them in. It's called zero-based, put them in this year. And this is what I'm talking about when I'm talking about building a budgeter. It's essentially the P&L, and then you've got 12 months here. So let me see if I can make this larger. No. So if I have 12 months of P&L from this past year, I'm just going to take all the expenses from each month, and I'm going to say, you know what, I'm not going to spend any more than that. I'm going to just put those in here. And that's going to be the expense budget that I create for myself. And then I'm still going to create a tuition number or a sales number, revenue number, that implies growth. So I'm going to hopefully make more profit because I'm going to lock the expenses in, and I'm going to raise the tuition. That's called zero-based budgeting. Now, one more way that you can budget, one more way that is just sort of a general and familiar way for a lot of people to budget, is bottom up. And that's more if you plan to invest. So let's say I'm going to take on real estate. I'm going to take on another 1,000 square feet to add some tutoring rooms to my business. So now I'm going to start on the expense side of things again, and I'm going to add that money into that particular line item. Now, that addition, though, at least in sort of good budgeting strategy, that addition should produce more revenue. So that focusing on the expenses first should create a dynamic where you use those expenses and you expect the increase to produce a return on that expense investment. And so there are a few different ways here to start your budgeting process. And it doesn't have to be too complex. It really doesn't, because at the end of the day, you just want you want it to be directionally accurate and to be a good way to measure your success against the goals that you create. That's it. Are there any questions, or do you want to go back and look at any slides and talk about anything in particular?